Hello everyone, how is your day going? In today's presentation, I will discuss some common money mistakes and how to prevent them at all costs. To achieve financial freedom, it is not how much you earn that matters, but how much you are able to keep and invest. Before we proceed, a quick reminder to please subscribe to my YouTube channel if you have not already done so. Also like and share this video, and remember to press the notification button. Now let's get started. Some common money mistakes and how you can prevent them at all costs. Number 1, not paying yourself first. In my previous video, I discussed the need for you to pay yourself first before you start spending your monthly salary. So, to correct this common mistake, I recommend that you pay yourself first before you start spending. For more information on how to do this, you can watch my video on how to pay yourself first. Number 2 common mistake: not having a money plan or a budget. Living your life, your financial life, without a budget is like building a house without a plan. A budget is a roadmap to building wealth. It is a must-have if you want to succeed financially. I would recommend that you watch my video on budgeting to learn more. Number 3, living other people's life. One simple and sure way to unnecessarily put financial pressure on yourself and your family is to constantly measure your financial success with those of other people. Living other people's life puts what is called lifestyle inflation on us, and it makes us to live above our means. The end result is poverty. Do not live other people's life. Be yourself and measure your financial success by your own standard. Next, paying off the wrong debt first. There are good debts, and there are also some debts that are bad. Now, when we want to pay back the amount that we borrow, when we want to reduce our debt or totally pay off our debts, do we sit down and think, which one should you pay first? Usually, most people don't do this. They make that mistake of just paying their debt without using a smart strategy. One recommendation I usually will ask people to do is to sit down and see, what kind of debt do I have? Do I have good debt? So debt that put money in my pocket? Or do I have bad debt? Debt that take money away from my pocket? So if you have good debt, don't be in a hurry to pay that off, because it's bringing you money, it's giving you leverage to grow. Now, for your bad debts, you have to do the analysis. Which of these debts have higher interest rates? Which of these debts have low interest rates? Typically, consumer debt will be the ones that will have higher interest rates. For example, your credit card debt, you want to make sure you pay that off. Other consumption loans, so that debt that you use to buy a big screen TV, that's your car loan. So you sit down and look at and analyze all these debts and pay off the one with a higher interest rate first, while you make minimum payment on the remaining debts to protect your credit score. Next, not having an emergency fund. Have you watched my video on emergency fund, or what I call the rainy day funds? If you have not done so, please watch that video. I cannot emphasize enough the need for you to set aside 3 to 6 months of your income or family expenses as a shelter for emergency or as a rainy day fund. This is like insurance. It will give you peace of mind to focus on investing and growing your money. Without peace of mind, you cannot think and know what and where to invest. Next, missing out on employers' matching contributions. Some organizations offer employers matching savings contributions. However, some employees don't take advantage of this, either because of lack of financial knowledge or because they believe that it will reduce their take-home pay. Did you know that this is free money? So a simple way to illustrate this is if my employer, for example, say, Lucky contributes $100 to your savings account, maybe a retirement fund, and we'll match it with another or by another $100. Now, if I sign up for that plan, that becomes $200, which means that additional $100 is like free money. Why not take advantage of it? If you do take advantage of that matching fund, irrespective of the percentage, because some may say 50%, 20%, that is free money. It will help you to get closer to your financial freedom. Now, if you have not signed up for your employer's matching contribution, either due to not having sufficient financial knowledge or for whatever reason, just believe what I say. Just go and sign up for that matching contribution. Sign up for the plan and review after 1 or 2 years, and you'll be happy that you did. Also, apart from signing, look at the options. Some may have 20% matching, some 50%, some 80%, or even 100%. My recommendation is that you take the highest possible deduction. You'll be glad that you did, and you will be able to adjust with whatever is the remaining balance of your salary. Next, living on borrowed money. One sure key to poverty is to always live on borrowed money. I know that sometimes life happens and we have to borrow from the bank, from family or friends. That's perfectly okay. But if you perpetually or continuously live on borrowed money, then you will perpetually or continuously remain poor. To achieve financial freedom, you must learn to save and invest, no matter how small. Next, living paycheck to paycheck. This is another sure way to poverty. Use a budget to plan your income and your expenses. No matter how small your income is, try to make savings as your first expense and increase the amount over time. Next, unnecessary spending. Unnecessary spending is usually based on impulse buying and not defining what you actually need and what you want. To avoid this mistake, you have to cautiously think and plan your spending based on budgeting. Use a budget. We have to stop here today. Remember that financial freedom will remain a dream without cautious action. Take steps today to avoid the common financial mistakes that we have discussed. Before I go, a quick reminder to subscribe to my YouTube channel if you have not already done so. Like and share this video with your family members and friends so that they can also benefit from the financial education that we are sharing together. If there are topics that you want me to discuss in the future, please put those topics in the comment section. Until my next presentation, thank you very much. Merci beaucoup and bye for now.